Everyone thinks the 2008 crash happened because of greedy bankers and bad mortgages. That's the story we were told. But if that were true, then why are the same signals flashing again? Louder, sharper, and this time inside the very system that claimed it learned the lesson. Look closer. The headlines say soft landing, inflation under control, and resilient labor market. But beneath that calm surface, America's financial bloodstream is clotting. Debt is compounding faster than income. Banks are quietly merging or failing. The same liquidity injections that once saved the economy are now the only thing keeping it breathing. In 2008, the collapse began in the mortgage market, a corner of the system few people watched. In 2025, the weak link isn't houses. It's the government's own balance sheet. Washington is now the subprime borrower. It spends what it doesn't earn, rolls over what it can't pay, and refinances the rest through the Federal Reserve, the same way Wall Street once refinanced toxic mortgages through shadow banks. We're told this is normal. Sovereign debt is safe. Money printing is policy. But it's the same illusion in a different costume. In 2006, rating agencies gave AAA scores to mortgage bundles that were mathematically doomed. Today, they give the same risk-free label to bonds backed by a government running $2 trillion annual deficits. Arithmetic doesn't care whether the borrower wears a suit or waves a flag. You might remember the panic of 2008, Lehman collapsing, markets freezing, credit vanishing overnight, yet that was only the symptom. The real disease was leverage, the belief that you could multiply paper promises faster than real wealth. The same belief now drives the U.S. Treasury. It borrows to cover old debt, pays interest with new debt, and calls it growth. History repeats not because people forget, but because systems protect their myths. Every empire has its official excuse for collapse. Barbarian invasions, market cycles, temporary shocks. But the truth is always simpler and crueler. Numbers grew faster than reality. Rome did it with silver debasement. France did it with assignats. America does it with the dollar and treasury bonds. If you listen closely, you can already hear the creak, the sound before the break. Bank reserves shrinking, bond yields surging, foreign buyers stepping back. The same stress points that cracked Wall Street in 2008 are now embedded in Washington itself. Only this time there's no higher authority to bail it out. If this opened another side of history for you, comment where you're watching from. To understand how we got here, you have to go back, not to 2008, but to 1913. That's when the United States quietly built the machine that would one day both finance its empire and endanger it, the Federal Reserve System. It wasn't born from crisis, but from fear, the fear of losing control over credit. The panic of 1907 had shown how fragile the banking system was when left to pure market forces. So, under the banner of stability, the nation's largest financiers, J.P. Morgan, Rockefeller's men, Kuhn Loeb, met with senators at Jekyll Island and wrote the blueprint for a central bank that would serve as a perpetual backstop for private risk. The idea was simple, brilliant, and dangerous. Create a lender that could create money from nothing, lend it to the banks, and smooth over every panic. It sounded like a safety net. In reality, it was a lever. The power to issue credit meant the power to expand illusion, to stretch the money supply far beyond gold, labor, or production. At first, this engine ran modestly, but by the time of the Great Depression, the Fed was already deciding who lived and who died in finance. Then came 1944, Bretton Woods. The US dollar became the center of the world's monetary universe, backed by gold at $35 an ounce. Nations held their reserves in dollars. The US promised convertibility. For a time it worked. The world trusted the promise because America held 2/3 of the world's gold. But power tempts excess. After World War II, the United States began to finance not just its economy, but its empire. Bases, alliances, wars, subsidies. By the 1960s, foreign central banks started noticing something strange. the number of dollars abroad was growing much faster than the gold reserves in Fort Knox. French President Charles de Gaulle called it out, accusing Washington of paying for its power with paper instead of metal. He demanded gold, and ships left New York loaded with bullion. In 1971, Nixon closed the gold window. The dollar was no longer backed by anything tangible. From that moment, money became debt, and debt became policy. Every dollar in existence was created by someone borrowing, a corporation, a consumer, or the government itself. The system could survive only through expansion. It needed constant growth of credit, like a shark that dies if it stops moving. Banks loved it. The more credit they issued, the richer they became. The Fed encouraged it, adjusting interest rates like an alchemist's dial. In the 1980s, deregulation unleashed a flood of speculative finance. In the 1990s, derivatives turned debt into assets. By the 2000s, leverage had replaced productivity as the core engine of the economy. The mechanism was now complete, a self-reinforcing spiral of debt, liquidity, and political convenience. Politicians discovered that deficits didn't matter as long as the Fed was ready to buy the bonds. Corporations discovered they could borrow cheaply to buy back their own stock. Consumers discovered they could live beyond their wages. The entire system rested on one silent assumption, that credit would always expand and confidence would never break. That's why 2008 wasn't an accident. It was the system reaching its mathematical limit for the first time. Mortgage bonds were simply the canary, the most over-leveraged link in a chain built on borrowed promises. The Fed stepped in, expanded its balance sheet from $900 billion to over $2 trillion, and rewrote the rules overnight. Quantitative easing became the new gold standard. Infinite money is the new faith. But faith, like credit, has limits. Every rescue comes with a price, dependency. Every bailout creates a bigger imbalance waiting to surface. The same mechanism that once saved capitalism from collapse now ensures that it can never truly recover, only inflate, deflate, and repeat. If you've ever wondered why crises now happen faster, why debt always rises no matter who's in power, this is why. We no longer have an economy that produces, we have a machine that rolls over old debt with new, a perpetual motion illusion. It began as a tool of stability, it evolved into an empire of credit. If this gave you a clearer picture of how the illusion was built, leave a note below. For a while, it all seemed to work. The graphs went up, the market smiled, and the headlines called it the longest expansion in history. Between 1983 and 2007, America lived through what economists later named the Great Moderation, low inflation, stable growth, and endless optimism. But it was a mirage built on leverage, not productivity. When the gold standard ended, a new faith took its place, the faith in the dollar itself. And faith can be printed. Every new crisis became an excuse to expand credit further. The 1987 crash, lower rates. The 1994 bond crisis, more liquidity. The dot-com collapse of 2000, slash rates to 1%. Each rescue prevented collapse and guaranteed the next bubble. You could feel it in the culture. The idea of saving quietly died. Why save when your house appreciates faster than your salary? Why produce when speculation brings 10 times the profit? The wealth effect replaced real wealth. Borrowing wasn't shameful anymore. It was patriotic. The Fed had turned money itself into a stimulus drug. Wall Street engineered the illusion. In the 1990s, derivatives were sold as risk management. In truth, they were multiplication machines for debt. Credit default swaps, mortgage-backed securities, synthetic CDOs, all complex names for one simple operation, taking $1 of collateral and promising 20 against it. It was the same logic as medieval alchemy, turning paper into gold, illusion into yield. Meanwhile, Washington discovered the political magic of the same mechanism. A society floating on cheap credit doesn't rebel. It consumes, votes, and believes in prosperity. Wars could be financed without new taxes. Social programs could expand without visible cost. Debt was invisible, abstract, until the moment it wasn't. But the key illusion wasn't in banks or balance sheets. It was in trust. Every bubble is a story before it's a statistic. The story of the late 20th century was that The Fed won't let the market fall. Investors repeated it like a prayer. Even when Enron collapsed, when tech stocks vaporized, the narrative held. They'll print. They'll fix it. And they did. Each time the Fed stepped in, it taught the market that risk was optional. By 2006, the entire financial system was leveraged to the assumption that prices only move upward. Homeowners borrowed against houses they hadn't paid for yet. Hedge funds borrowed against assets that didn't really exist. Governments borrowed against taxes that wouldn't be collected for decades. Money became memory, a promise about tomorrow used to pay for today. And for a while, it felt like prosperity. GDP grew, unemployment dropped, the Dow Jones broke records. But look closer and you see the decay. Wages stagnated while asset prices exploded. Manufacturing hollowed out, replaced by financial engineering. The real economy, the one that builds, mines, farms, and trades, was quietly shrinking under the weight of its own credit scaffolding. Every empire in history has had this phase. Rome had its bread and circuses. France had its assignats, paper money printed against confiscated land. Britain had its colonial debt schemes. America had its subprime mortgages and treasury bonds. Each believed they'd invented a new kind of prosperity. Each was wrong. The numbers grew faster than the gold, faster than the real income, faster than trust itself. And yet, in the mid-2000s, no one cared. Economists called it financial innovation. Politicians called it home ownership for all. The rest of us just called it normal life. But arithmetic is patient. It doesn't warn or argue. It waits. And when the math stops balancing, when liabilities outgrow assets, when promises outnumber real goods, illusion turns to panic. If this part made the boom years look a little different, share it. History's biggest bubbles never look like bubbles while you're living in them. It always happens the same way. First comes the euphoria, the charts racing upward, the belief that this time the rules are different. Then comes the tremor, a small failure dismissed as contained. And then, all at once, the system built on confidence collapses under its own weight. In 2007, that tremor was called subprime. The phrase sounded technical, harmless, just a segment of the mortgage market. But behind those three syllables was the entire structure of modern credit. Banks had sliced, sold, and insured the same debts so many times that nobody could tell who owned what or who owed whom. It wasn't just bad loans. It was a hall of mirrors made of promises. When the first cracks appeared, Bear Stearns hedge funds imploding in June 2007, the system tried to ignore it. Markets kept trading, politicians reassured. Central bankers called it manageable. But numbers don't lie. Within a year, Lehman Brothers, a 158-year-old institution, vanished overnight. Trillions in global assets froze because of something as simple as distrust. Every bank suspected every other bank was lying about its balance sheet. And they were right. Here's the truth most textbooks skip. It wasn't just a financial crisis. It was a crisis of collateral. There wasn't enough real value behind all the paper. The math that once worked, 40-to-1 leverage ratios, endless refinancing, derivative hedges, suddenly stopped adding up. The entire illusion depended on infinite liquidity, and when it vanished, so did the illusion. The government's answer was panic dressed as policy. In September 2008, Treasury Secretary Hank Paulson and Fed Chairman Ben Bernanke launched the $700 billion TARP bailout. Temporary, extraordinary, to restore confidence. But it wasn't restoration. It was resuscitation. The patient was technically dead, kept alive only by artificial credit. And then the unthinkable became normal. The Federal Reserve began printing money on a scale that would have been considered lunacy a decade earlier. By 2014, its balance sheet had grown to over $4.5 trillion. Quantitative easing flooded markets with liquidity, suppressing interest rates, and inflating every asset from real estate to tech stocks. Wall Street was rescued. Main Street wasn't. The political cost was enormous. The middle class, the people whose pensions, savings, and wages were tied to the real economy, discovered that the recovery wasn't theirs. The wealth gap exploded. The top 10% gained more in paper assets than the bottom 90% earned in real labor. It was the moment when capitalism quietly shifted from production to preservation. The preservation of financial elites at any cost. And yet almost no one went to prison. The same institutions that caused the collapse were rewarded with new money, new rules, and new power. The lesson was clear. In modern America, risk is privatized profit but socialized loss. If you are big enough, failure becomes policy. That's when politics broke too. The 2008 crash wasn't only about economics. It was the moment public trust defaulted. People saw that the system wasn't built for them. The slogans changed, the parties changed, but the mechanism stayed the same. Endless debt, endless rescue, endless denial. Mathematics, however, doesn't vote. The same ratios that destroyed Lehman Brothers are now haunting the U.S. government itself. Trillions in federal debt, interest payments surpassing military budgets, deficits financed by the same Federal Reserve that once saved the banks. The empire has become the borrower, and the too-big-to-fail institution is the state. When numbers outgrow reality, politics can only stall the reckoning, but not stop it. That's what 2008 taught, if anyone was still listening. If you felt a chill reading this, it's because we've seen this movie before. Only this time, it's not a bank collapsing. It's the balance sheet of an empire. Comment if you can sense the pattern repeating. You're living inside the sequel. The actors have changed, the script has not. After 2008, the world swore never again. They built new regulations, stress tests, capital requirements. But instead of curing the disease, they institutionalized it. The illusion became policy. The Federal Reserve, once a lender of last resort, turned into a dealer of first resort. Every downturn since then was met with the same reflex. Print, prop, postpone. In 2020, when the pandemic froze the global economy, the Fed created over $3 trillion in new money in a matter of months. That wasn't a rescue. It was a redefinition of money itself. The public story was noble, supporting households and businesses. But look where the liquidity went. Corporate debt exploded. Stock markets soared even as millions lost their jobs. By 2021, 40% of all dollars in existence had been created in just 2 years. It was the most aggressive monetary expansion in U.S. history. The same trick from 2008, only multiplied. What happens when you double the size of the illusion? You get inflation. Not the slow, steady kind, the kind that exposes the hidden cost of every bailout. Prices rise not because goods are scarce, but because trust in the currency quietly erodes. The same dollar that once bought you security now buys uncertainty. The government's response? Denial wrapped in statistics, transitory inflation, strong consumer demand, healthy labor market. But you can't print confidence. By 2023, the Treasury's interest payments had passed $1 trillion annually, more than defense, more than education. America was paying yesterday's bills with tomorrow's taxes. The nation that once lent to the world now borrows from itself. Foreign powers began to see the weakness. China and Russia started reducing dollar reserves. The BRICS bloc discussed trade in local currencies. Even traditional allies began buying gold again, the same move de Gaulle made in the 1960s when he saw the imbalance forming. History was echoing, not rhyming. The parallels with 2008 are uncanny. Back then, toxic assets were hidden inside mortgage bonds. Today, they're hidden inside the government's own balance sheet. Trillions in treasuries that lose value when interest rates rise. Banks hold them as safe collateral, just as they once held subprime loans. The same story, a bigger stage. And just like before, the illusion depends on belief. Belief that the Fed can manage everything, that deficits don't matter, that the dollar's supremacy is eternal. But look closer. Markets now move not on fundamentals but on expectations of policy rescue. Investors don't ask, what is this asset worth? They ask, what will the Fed do next? The market no longer prices risk, it prices faith. That's the most dangerous phase of any empire, when it stops being productive and becomes performative. When wealth is no longer created, only circulated through the hands of those close to the source. Wall Street becomes Versailles. The Fed becomes the court magician, printing confidence, inflating bubbles, distracting the crowd. Yet arithmetic is creeping back into the story. Every bailout raises the base level of debt. Every emergency becomes permanent. And every dollar created dilutes the meaning of the last one. The same mechanism that made the recovery possible now guarantees its eventual failure. What we call modern monetary policy is the same ancient delusion, that paper promises can outpace real production indefinitely. It's what France tried with assignats, what Argentina tries with pesos, what empires always try before the ledger balances itself through collapse or reset. If you're hearing this in 2025, know this: we're living in the late phase of a long experiment. The symptoms aren't random, they're mathematical. Inflation, polarization, currency wars, all signs of a system eating its own credit to survive. If this connected the dots for you, tell me where you're watching from, because when the story turns global, everyone becomes part of the balance sheet. Every empire believes it's different. Rome said its coinage was eternal. France said its paper was revolutionary. Britain said the sun would never set on its debt. And America says the dollar will always be trusted. But arithmetic doesn't care about flags or faith. It cares about ratios. How much you owe versus how much you earn. How much you print versus how much the world believes in you. The numbers that once hid in financial reports now sit in plain sight. $35 trillion in federal debt, $2 trillion in annual deficits, $1 trillion in interest payments. No war, no pandemic, just inertia. This is how systems end, not with riots or crashes at first, but with normalization. You get used to absurdity. Trillions become routine, bailouts become policy, inflation becomes expected. People stop questioning because the math feels too big to matter. That's how it felt in 1789 Paris, in 1923 Berlin, in 1998 Buenos Aires. The logic of collapse is always psychological before it's financial. The American system today doesn't need an external enemy. Its opponent is its own accounting. Each year it borrows more to sustain promises made decades ago, to retirees, creditors, voters, and itself. It's not a conspiracy, it's a compulsion. The mechanism built for growth has become a trap of maintenance. And yet, there's beauty in truth, because when illusions end, reality becomes visible again. When the credit bubble deflates, what remains is the only thing that ever mattered: production, labor, trust, and discipline. Every crisis is a purification by mathematics. That's the paradox. Collapse isn't destruction, it's revelation. It shows what was real all along. If you strip away the leverage, the speculation, the political slogans, you see the core law of every economic age. No system can live forever on promises. Not Rome's silver, not France's paper, not America's bonds. If you're hearing this in 2025, understand, we are not witnessing the end of the US. We are witnessing the end of a phase. The phase where credit replaced value and where illusion replaced honesty. What comes next will be painful, but it will also be real. Arithmetic cannot be deceived. It only waits for the moment when the story and the numbers finally meet.